Corporate Finance Practice Problem using Onenote. 5-year MACRS Depreciation, Cash Flow, and Net Present Value. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side in the Practice Problems area and in the 1238 5-year MACRS Depreciation, Cash Flow, and Net Present Value tab. Also note, when using OneNote, look at the immersive reader. Our presentations up top will be down here in the text area as well. The text area with the same name, same number, having transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon up, we have our information up top, going through the calculations on down below. This will be another longer practice problem, taking into consideration multiple types of concepts we've taken a look at in prior presentations. This time we have the 5-year MACRS fixed asset, and the cash flow is going to be over the 6-year time period. So the recap, we're going to be putting money down up front. We're going to be putting $700,000 down up front in the hopes of receiving a return on it in the future for years 1, 2, 3, 4, 5, and 6, $200,000, $230,000, $210,000, $190,000, $170,000, $115,000 respectively, tax rate at the 30%, cost of capital at the 11%. So we put the $700,000 up front to get that money in the future, and we're putting it into equipment, which is a 5-year MACRS fixed asset equipment, which is a tax code type of depreciation category. Remember that when we think of our cost flow assumptions and try to present value them to decide whether or not to put money in or not, we're typically thinking of a cash basis type of system. Depreciation is not cash basis. That would take the cost and apply it out in accordance with the years that would be benefited from the purchase that we are making. So we normally would not take it into consideration, but we need to, because for a tax side of things, it will have a tax impact, and the tax impact can be significant and cash flow related. Therefore, we're talking about depreciation not on the book side of things, but on the tax side of things. So that's the first place we will start at. We have the 5-year MACRS fixed asset. Remember that depreciation can be quite complicated, so you have to change the laws, could change from year to year. There might be special depreciation in year 1 or 179 depreciation. We're going to give the general baseline rules for the MACRS depreciation, which is kind of the heart of the depreciation and has been for some time, to consider the depreciation and tax impact, recognizing that it will be, important for us to look into those. So we got the $700,000 on the fixed asset. If we go to publication 946 on the IRS website, irs.gov, type in pub or publication 946, you can read more about depreciation. In table 1A, we have the depreciation rates that could be used here. Note we're looking at the 5-year property this time, which they have the rates for. So you could multiply then the cost times the rate for each year to pick up the amounts. But we're going to recalculate it using a double declining half-year convention, because that's the general rule, although there will be a slight deviation that we want to take a look at when we work through this practice problem. And you can see it down here where they kind of have the same percent for 4 and 5. So basically it's a double declining balance, half-year convention, and then they kind of tweak it a little bit as well. So we'll mirror that and estimate it. It won't be exact. You could use these percents to work it out, but I think it's useful to get an idea of what the double declining balance is doing. So we'll do that first. Then we'll take a look at the cash impact or the tax impact. Then we'll take a look at our cash flows. Then we'll present value this thing. All right, let's do it. We're going to do the MACRS depreciation. We're going to say the cost is the $700,000. That's how much cash we're putting down. We're going to say that, and we don't have to basically put cash down possibly for it to be depreciated, but we're assuming in our practice problem we already paid the cash, but now we have to deduct it in accordance with the depreciation laws. So we're going to take that $700,000 divided by 5 years, and that's going to then be the 107 or 140. That would be the straight line amount that we would depreciate. We take that, if I divide that again by the $700,000 cost, we get the rate of the straight line depreciation, which would be the 20%, which you can also calculate it by taking 1 divided by 5, getting then that 20% straight line rate. If we double it, we then get 40%. That's the double declining part of the MACRS double declining half-year convention. Taking that 0.4%, 0.4 or 40%, times the 700,000 cost would then give us the 280. That's what the double declining rate would be for an entire year. But we assume for taxes that it was purchased in the middle of the year, even if we purchased it on January 1st, that's the half-year convention. There could be deviations to that rule. That's the general rule, however. So if we take that 280,000, divide it by 2, and say we have 6 months of depreciation, basically we're at the 140. That 140 is the same as the straight line rate, but they are different because it's not straight line. It's double declining balance half-year convention. That's important because if you go into year 2 with straight line, it'll be wrong. So year 2, we're going to take that 40%, same double declining rate, times the cost minus the accumulated depreciation, which the cost was 700,000, depreciation 140,000. That's going to give us the 560 times the double declining rate, 0.4, is going to give us the 224,000. There is no half-year convention, so that would be the depreciation for year 2. Year 3, we're going to take that 40%, and then we're going to take that where we were before, which was the 560,000 minus the 224 we took last time. So we have the cost minus the accumulated depreciation is the 336,000 times the 0.4 gives us the depreciation of the 134.4. There is no half-year convention here, so we're good there. Then the 40% times, we're going to take then the 336,000 where we were last time, minus the 134,400 depreciated in year 3, gives us the 201,600 times 0.4, which is going to give us then the 80,640. So there's the 80,640. And then the last year or the last couple of years here, year 5, this is where they deviate a little bit. And you can tell here on the report that they use the same rate for these last two. So we'll kind of mirror that in our calculations just to give you an idea of what's going on in the code. So this is kind of their tweak of the code here. So we're going to say then we've got the calculation of the 201,600 minus the 80,640 gives us the 129,60. But instead of multiplying that times the 40%, we're just going to mirror the same 80,640 because they use the same rate in the code there. So I'm just going to mirror that with this same calculation to get a more close approximation. And you can see how this straight line, the double declining half-year convention is being tweaked a little bit for the tax code. And then we have finally, if we took the amount of the 129,60 minus the 80640, the last year's the plug, as is typically the case with the double declining balance, to give us that last amount. So if we add all these up, we should get to the total of the 700,000. So year 1, 140,000. Year 2, 224,000. Year 3, 134,400. Year 4, 86,40. Year 5, 80640. And 6,40320. Notice it took us 6 years here. Hold on a second. That didn't happen. 140,000 plus 224,000 plus 134,400 plus the 80640 plus the 80640 plus the 40320 gives us the 700,000. Notice it took us 6 years to get there here, even though it's 5-year property because the half-year convention. So you can think about it as half happening in year 1 and kind of half happening in year 6, although 6 is like a plug because it's the double declining rate that is being used. Also note that we're basically getting the tax benefit then of the cost over the 6 years, even though on a cash basis, we paid for it up front in year 0, the 700,000 was already paid. That's important not because we're converting to an accrual basis for our calculations here, but because there's going to be a tax impact, which has a cash impact based on this depreciation. So once we have this, we can then figure out the tax impact. We're going to say, all right, now we're assuming we have these cash flows. These are the cash flows that we expect to be happening from year 1 to 6 in order for us to put down that 700,000 to get the equipment, whatever it is, the 5-year MACRS fixed asset. We're going to need to then get these future cash flows. So we want to think about the tax impact from this cash flow. So we're just going to list these out: year 1, 2, 3, 4, 5, 200,000, 230,000, 210,000, 190,000, 170,000, and 115,000. Then we're going to subtract out the depreciation. So we calculate the depreciation here. So we're just taking this whole column, pulling it on down. This is going to be the depreciation that we want to deduct so that we can then figure out the tax, which will have a cash flow impact. So, for example, the 200,000 minus the 140 is the 60, the 230 minus the 224 is the 600, the 210 minus the 134.4 is the 75.6, the 190 minus the 80,640 is the 109,360, and so on. Then we can calculate our taxes by basically simply taking, for example, the 60,000 times 0.3, that's going to give us our 18,000. We could take then the 6,000 times 0.3, that's going to give us our 1.8. We're going to take then the 75,600 times 0.3, that's going to give us our 22,680, and so on. Notice that that 30% up top might be the marginal rate. Remember, we have a progressive tax rate. If we're making this decision on the margin, it's our last decision, then we might be taking our highest tax rate that we're in order to calculate that. So you would have to figure out, which tax bracket are we in? What is this going to be calculated on? And typically, if this is the next decision, then that would be whatever our tax rate is here, and it might then go up to the next bracket depending on how much income we have as well. So then we're going to have the earnings after taxes, which we would then simply subtract these out. The 60,000 minus the 18,000 is the 42,000. 6,000 minus the 1,800, 4,200. 75,600 minus the 22,680 is the 52,920, and so on. And then we're going to add back the depreciation. So here's the depreciation column. We're just adding it back in because it's not cash related. The only reason we subtracted it is to figure the taxes. Now that the taxes have been figured, we're going to add it back in to get back to a cash basis method in essence. That then 42,000 plus the 140,000 is the 182,000. 4,200 plus the 224,000 is the 228,200. 52,920 plus the 134,400 is the 187,320, and so on. So this is in essence our cash flow now, and that puts us kind of where we have been in some of our prior net present value calculations. In other words, in prior presentations, you've seen this set of numbers, and you would expect then to do your net present value calculations upon them. In this calculation, we had to do some more research to figure out what our cash flow is. And you can imagine this being much more detailed. You can imagine a situation where you have very complex cash flows or budgeting that you're imagining into the future. And once you have then your cash flows, then you can do your present value analysis, your net present value analysis. Noting that the net present value analysis typically assumes that these cash flows happened at the end of the period. That's how net present value typically works. When in reality, if you're doing budgets or something like that, it might have happened during the period or throughout the year. So that's one kind of limitation with that method, but it is what it is. So now we take these cash flows and we're going to present value them. We could do this in a vertical fashion or a kind of horizontal fashion. Given the fact that we already have the table in this format, we'll start off with a horizontal fashion because that might be the natural next step in this method. So then we now know that the cost of capital is 11%. You might call that the required rate of return, the cost of capital, the discount rate, the hurdle rate. That's the rate at which we need to clear. We need to clear that rate in order to possibly accept the project. It includes the amount of gain that we want in it. Therefore, if the net present value calculation is above zero, then it includes the 11% in it and may be something we accept. So then we're going to do our calculations here. We're going to take the cash flows that we had, same cash flows up top. We're just mirroring them down here. Notice we numbered it up top. Those numbers help us to calculate this if we were to do this in Excel with the present value calculations, which we will do now. So this is period 1, the 182,000 present valued back 1 year with a discount rate or cost of capital, 11%, is 163,964. Calculated down here in Excel. Note that if you want to know how to calculate this with multiple different ways, like tables and with formulas, you can look at the prior section where we concentrate in on that. When you get to this kind of complexity of having multiple different calculations you need to do, it's useful to use Excel. Even test questions would have to limit the calculations a lot, typically, if they're going to pull away your financial calculator or Excel, so that you can have the time to basically do that. But if you're in that situation, you want to know that, look at the prior presentation so you can see how to calculate these in multiple different ways. Present value, negative present value of the rate. The rate's going to be that 11%. Notice here it's represented with an absolute reference, $ before the B and the 14, so that when I copy it across, it will not move that 11% amount. Comma, number of periods. The number of periods is 1. You could have hard-coded it here, but I'd rather have it referencing in this cell, so when I copy it across, it will then pick up 2 and 3 and so on as it should for the formula. Comma, comma, future value then is the 182,000. That gives us the discounted amount of the 163,964. Period 2, the 228,200 discounted 2 periods back, 2 years back at the 11% is the 185,212. Looks like this. Negative present value of the rate, which is going to be the same cell here. That's the 11% absolute reference. Comma, number of periods is now 2. Instead of hard-coding it, we have the cell reference moving M10 to N10. And then we have comma, comma, and the future value is that 228,200 moving from cell M11 to N11. And there we have that. If we continue this process, the 187,320 discounted 3 years back at the 11% is the 136,967. Period 4, year 4. The 157,192 discounted 4 years back at the 11%, 103,547. The year 5, 143,192 discounted 5 years back at the 11% is the 84,977. And year 6, the 92,596 discounted 11% 6 years back is 49,506. If we add up all these items, then we're at the amount of the 724,173 of the present value. Now, we want to compare that to what we put in, which was at period 0, which was the cost of the equipment, which we paid for at period 0, 700,000, even though we had to depreciate and allocate the cost for taxes. So the 700,000 went out in period 0, therefore no discounting needed. The 724,173 minus the 700 gives us the 24,173. Because that number is positive, anything above 0 means that we cleared the 11% rate and possibly would then take on the project. Now, we could do the same calculation in this format in like a vertical fashion, just changing the axes. And that's how we've done it in the past. So if we did it that way, we'd have zeros period 0 through 6. And then we just list our cash flows in this format. This time, I'll list period 0 with our cash outflow of the 700,000 as a negative number. And then the inflows in the same format. It's just these same inflows that we had up top, which we calculated in our cash flow here. But now they're vertical. So period 1 through 6, we have the cash flows. And then we can apply our present values in this format, which we will do with the Excel formulas once again. I'm going to apply the present value to this 700,000, even though it's at period 0 and therefore the same number, so that I have a uniform column and then can copy it down. So it would look like this. Negative present value, the rate would be then this 11%. Notice it's an absolute reference, $ before the B and 14, comma, number of periods is going to be the 0. That's going to be the U2. It's referencing this cell instead of hard coding or typing the 0 so that we can then copy it down. Comma, comma, future value 700,000. That gives us then the 700,000 given it's at period 0. And then we have the period 1, the 182,000. If we present value it back 11%, we get the 163,964. If we copied the formula down, it would look like this. Negative present value, the rate, absolute reference, same cell, comma, number of periods is now 1. Which is pulling from this cell, which you could see moved from U2 to U3 as we copied it down. And then comma, comma, future value is now the 182,000, which you could see also moved down from V2 to V3 to pick that up. So there is that. If we continue that, then of course, year 3, the 228,200, present valued 2 years back at the 11%, 185,212. The 187,320 present value 3 years back at the 11% is the 136,967. The 157,192 present valued 4 years back at the 11%, 103,547. The 143,192 present valued 5 years back at the 11% is the 84,977. and the 92,596 present valued 6 years back at the 11% is the 49,506. Adding up this column gives us the 24,173. Note that if we did not present value, we're looking at the 290,500 just in cash flows without the present value. These two numbers are a little bit deceiving because remember that this 24,173 does not represent basically what we've received after taking into consideration, say, inflation, because we discounted these at 11%, which includes not simply inflation, but also what we expect for our required rate of return. So anything above zero would have the 11% cleared and possibly be something we would accept. Now, the fact that this is above zero we might then ask, well, what is the rate of return then? It's above 11%. That would be answered with the internal rate of return, which would be calculated like this, equals internal rate of return, the values of this series of numbers, the negative 700 to the 92,596, giving us 12.33. 12.33, in other words, is the rate at which this series of payments present valued would then be zero. In other words, if we present valued this net present value using, instead of 11%, the 1233, we would then or should get a result of zero. So bottom line would be this is above the 11%, therefore something we might pick up because this number is greater than zero. What exactly was the rate of return, or what would the rate of return need to be to make this zero? It would need to be the internal rate of return, the IRR, of the 12.33%.